Money is more than numbers on a bank statement. It is memory, fear, hope, identity, a silent yet powerful force that shapes how we live, who we become, and the choices we make when nobody is looking. For many, the story of money begins long before the first salary check or investment return. It begins in childhood, in the neighborhood where you grew up, the economic climate you witnessed, the whispers around dinner tables about what it means to be comfortable, safe, or successful. These early experiences imprint on us deeply, coloring our ideas of risk, security, ambition, and worth. Consider two friends, born in the same city but decades apart. One grew up during a time of economic boom, their parents secure, their future seemingly promised. The other grew up when jobs were scarce, inflation high, and every shilling felt precious. To the first, investing in stocks might feel natural. To the second, any risk might feel like gambling with a family's future. Their choices, how much they save, spend, invest, or even fear debt, may appear irrational to an outsider, but to each individual, their behavior makes perfect sense. What seems like overcautiousness or reckless ambition is often just a story they learned early, shaped by context, emotion, and necessity. This is the world that no one's crazy lives in, where every financial decision is rooted in a life lived, not a spreadsheet calculated. Yet beyond upbringing and personal history lies another force, luck and risk, two invisible partners in every financial journey. Sometimes success is no more than being in the right place at the right time. Failure may come not because of poor choices, but because circumstances suddenly tilt against you. Think of those who strike gold or lose everything, depending on factors beyond their control. Recognizing the role of chance doesn't make you cynical, but humble. It reminds you that even your best-laid plans must leave room for the unforeseen, and that copying someone else's path is no guarantee it will yield the same result. In a world where so many chase more, there is a quiet, radical art in deciding when enough is enough. Many people who attain great wealth still feel poor, not because of lacking money, but because their goalpost keeps moving. The richest among us are often not those with the biggest mansions or flashiest cars, but those who know their limits, hold tight to modesty, and find contentment not in outward display, but inward peace. Greed, insatiable, comparison-driven greed, has swallowed fortunes and destroyed lives. Learning to step off that treadmill to define what enough really means for you is perhaps the hardest financial skill of all. Then, there is the almost magical force of time compounded. Small choices made early, repeated consistently over years, quietly growing into something far greater than any one grand move. As one legendary investor showed, the bulk of his wealth came not from timing markets, but from staying in the game for decades. That is the power of patience. That is what happens when you resist the urge to chase the extraordinary and instead let the ordinary accumulate steadily. But building wealth and keeping it are not the same. Accumulation often demands boldness, risk, ambition, even a touch of audacity. Preservation demands something else: humility, vigilance, frugality, and a willingness to walk away from what glitters. Without a margin of safety, without fear of volatility, even good fortune can evaporate. The ability to survive, to outlast the chaos, is as valuable as the ability to win the lottery of compounding. And above all, wealth is not what you show the world. It is what you don't show. It is the savings unspent, the freedom purchased with time, the options quietly waiting in the wings. A luxury car may win nods, but real respect, real security, comes from peace of mind, from control over your time, from dignity unshaken by markets, trends, or comparisons. Because the highest return money can pay is not in interest or dividends, but in the simple ability to wake up one morning and say, I own my time. As you follow along this journey, through stories of luck and ruin, greed and contentment, risk and compounding, I invite you to see money not just as currency, but as character, not just as a tool, but as a mirror, reflecting your past, shaping your present, whispering possibilities for your future. Let it teach you not only how to build wealth, but how to live with it. Welcome to a voyage through the psychology of money. May it challenge your assumptions. May it awaken clarity. And above all, may it help you define wealth not by what you spend, but by what you value. Chapter 1. No one's crazy. Money is a story we inherit before we ever learn arithmetic. It lives in the kitchen table, conversations we overhear, the urgency in a parent's voice when bills arrive, the pride or shame attached to a paycheck, the single memory of losing a job, or the quiet triumph of being able to pay for school. Those early scenes become a private grammar for how risk, comfort, and success should sound, and that grammar shapes every financial choice we make. What looks irrational from the outside often reads like the only sensible chapter in a person's book. That is the essential claim of this chapter. No one is crazy about money when you read the whole story that led them there. I remember two women I once knew, both measured by the same salary band and living in the same city. One would splurge on dinners, gadgets, and trips. The other kept a meticulously patched wardrobe, turned off lights obsessively, and refused to carry credit card debt even for emergencies. To friends, the spender looked reckless, and the saver looked anxious. To understand them, you had to rewind. The spender grew up in a household where scarcity was rare, and generosity was how love was expressed. Money was a resource to be used. The saver had lived through a period of joblessness and watched her family's home sold at auction. Where one heard opportunity, the other heard catastrophe waiting in the wings. Both responses made perfect sense when anchored to those histories. This is not condescension, it's context. Research confirms what stories reveal. Childhood conditions and the environments we grow up in leave measurable marks on how we handle risk and money as adults. Studies show that early socioeconomic status, local social norms, and even the neighborhood where a child is raised influence financial behaviors decades later, from risk tolerance to credit habits. Two people raised in similar incomes but different neighborhoods can end up with markedly different credit scores and attitudes about debt and saving. Those differences aren't merely personal failings. They are the legacy of experiences, information, and role models absorbed long before a financial education course could change them. If we accept that people act according to the maps they were given, maps that were drawn by their unique mix of history, luck, trauma, and culture, the moral of this insight is not to excuse poor choices. It is to reframe how we respond to them. Instead of ridicule, we can ask better questions. What story taught this person that debt is fatal? Why does someone equate frugality with dignity while another equates restraint with missed chances? What invisible threats were they protecting themselves from? Morgan Housel's point is humane and practical. By seeing the logic behind behavior, we become less likely to copy it blindly and more likely to design financial systems and habits that actually work for our lives. real life offers stark illustrations. During the Great Depression, entire communities adapted survival habits, gardening, mending, shocking thrift that lasted lifetimes and were passed down to children who never experienced the emergency themselves. Those descendants often behave with extraordinary caution around money, even in times of abundance. Conversely, those who grow up amid prolonged prosperity may develop near unshakable faith in markets and institutions, sometimes underestimating how quickly fortunes can change. Neither stance is inherently irrational. Each is an adaptation to a perceived environment. Understanding that helps explain market behaviors, household savings rates, and why bubbles and panics often catch whole cohorts by surprise. This chapter asks us to replace angry shorthand. They're just greedy. They're just naive, with curiosity. It asks financial educators, policymakers, and families to remember that advice must meet people where they are. Practical guidance that ignores lived experience will be ignored, rejected, or half implemented. When we teach someone to invest, to budget, or to borrow, we are not merely transmitting rules. We are attempting to rewrite a story. The only way to make that rewrite stick is to understand the original narrative and offer alternatives that feel safer, more believable, and more aligned with their emotional truth. Finally, recognizing that no one's crazy reframes how we look at ourselves. It makes room for compassion and for strategy. If your aversion to risk comes from an early loss, compassion allows you to name that fear rather than be shamed by it. Strategy allows you to design steps small enough to build confidence without betraying your survival instincts. If your comfort with risk comes from a privileged runway, honesty allows you to see what you might underprice, and humility helps you build guards. Financial wisdom is rarely pure math. It's the delicate work of aligning your plans with the person you are and the person you want to become. That's the practical promise of this chapter. When you read the whole story, you see that people's choices are usually neither crazy nor simply right. They are human. As you move through the rest of this book, keep this one idea close. Before you judge the money choices of others or your own, ask for the backstory. The world of finance is noisy with numbers, but beneath those numbers are lives. Read them well. Chapter 2: Luck and Risk. Luck and risk are the quiet partners in every financial life. They are not poetic metaphors, they are forces with measurable consequences. Luck arrives as timing, geography, parentage, or a single fortunate meeting. Risk is the coin flip you accept when you step into the market, start a business, or sign a lease. Together they carve huge swaths of difference between otherwise similar people. Education, talent, and effort matter. But so do the accidents of circumstance and the invisible tail events that can make or break a lifetime of plans. Think of two entrepreneurs with similar ideas, drive, and education. One's product finds a lively, receptive market because a regulatory change opens the door. The other launches into an inhospitable moment and folds. Studies of founders and venture outcomes show that successful entrepreneurs often attribute at least part of their success to luck, and empirical work confirms that randomness can amplify small differences into dramatic outcomes. That does not deny skill. It simply means skill often operates alongside, and sometimes underneath, a large element of chance. Recognizing this truth keeps us humble and cautious, and it protects us from the dangerous habit of copying winners without understanding the context that made them winners. History hands us vivid examples. A person born in 1955 in Omaha, fortunate to grow up near a community of investors and with early access to markets, had decades to compound capital and learning. Another person with identical intelligence and effort, but born into a war zone or an economy in collapse, will face constraints that no amount of willpower can fully erase. This is not a moral judgment. It's an empirical fact about how luck mixes with life. Research on the role of luck in economic development and personal success shows that geography, timing, and random shocks materially shape outcomes, and that policy and planning should take these realities into account. If luck gives you an opening, risk determines whether you keep it. Risk is the predictable unpredictability built into returns. Markets rise and fall, technologies disrupt industries, illnesses and accidents happen. Effective risk management is not about eliminating risk. That is impossible, but about sizing and surviving it. Investors who win are often those who plan for survival. They build portfolios that can live through a recession. They keep reserves for bad years, and they adopt strategies that allow them to stay in the game long enough for compounding to work. Risk management, from diversification to margin of safety, is the difference between a temporary setback and financial ruin. A small real-life story captures both forces. Two friends, both brilliant coders in the same city, start companies. One secures seed funding because an investor who believes in their idea happens to attend the same meetup where the founder spoke. The other struggles to get attention in a quieter quarter. Years later, the first company is a headline success. The second survives quietly but sustainably. Which friend is more skilled? Perhaps both are. Which one was luckier? Clearly, the first. Understanding this split prevents us from mistaking the past's visible success for a foolproof blueprint. It also explains why copycat strategies often fail. The visible actions are only the tip of a hidden iceberg of unrepeatable circumstances. Luck also distorts narratives we tell ourselves about merit. When someone prospers, the story that comforts us is usually talent plus work. But because luck influences outcomes so strongly, success stories are survivorship biased. We see winners and infer cause from correlation, ignoring the many unseen actors who followed the same playbook and failed. That bias fuels imitation. We try to replicate careers, investments, or habits that appear to have produced extraordinary results, and it sometimes pushes people into needless risk. The antidote is not passivity, it's realism. Acknowledge luck, study skill, and manage the risk of failure. What, then, should practical financial wisdom look like in a world shaped by luck and risk? First, humility. Recognize that part of your success may be accidental and part of your failure may be unlucky. Second, diversification and buffers. Avoid putting your life on the line for a single outcome. Third, resilience. Design a life that can absorb shocks so you can stay long enough to let favorable luck compound. Fourth, skepticism about copycat prescriptions. What worked for someone else often includes unrepeatable elements. Finally, generosity. If luck helped you, pay it forward. Build structures and relationships that widen opportunity for others whose stories didn't include the same good fortune. Morgan Housel's lesson is practical and humane. When we see the role of luck and the omnipresence of risk, we stop celebrating winners as infallible models and start crafting plans that prioritize survival, consistency, and freedom. That mindset doesn't promise spectacular short-term wins, but it does offer the only reliable way to benefit from the long, rolling advantages that make fortunes in the real world: patience, endurance, and a preparedness to face the unpredictable. As you listen to the chapters that follow, carry this idea with you. Success is joint custody. You and the world both hold a claim. Do what you can, skillfully and bravely, but always give risk its due and luck its place. Design a life where good fortune can be kept and bad fortune can be lived through. That is how ordinary people, not just headline-making winners, can build extraordinary financial lives. Chapter 3: Never Enough. Greed is a quiet thief. It doesn't burst through the door wearing a mask. It arrives politely, dressed as ambition, persistence, and the reasonable desire to improve. It whispers that the next achievement, the next contract, the next investment, the next upgrade will finally settle the unease. For some people, that whisper becomes a roar that never quiets. The central danger is not that wealth corrupts. It is that the feeling of not enough reshapes our goals so relentlessly that yesterday's summit becomes today's foothill. Knowing when to stop, when you have enough, is a discipline as rare and valuable as any investment skill. Imagine a musician who earns tens of millions at the height of fame, and then, in a few short years, finds himself bankrupt. His record sales were enormous, his tours packed, yet his financial collapse was not from a single bad bet, but from a pattern. Expenses ratcheting up with status, commitments multiplying, and the belief that spending the next level up would bring the same joy as the last. This is not merely a celebrity cautionary tale, it is a human one. When comparisons and expectations keep moving the finish line, even enormous earnings can vanish. MC Hammer's fall from massive wealth into debt is an arresting example of how lifestyle inflation, over-leveraged ventures, and a relentless need to signal success can destroy financial security. Wealth without a boundary becomes its own risk. Consider athletes who earn hundreds of millions and still declare bankruptcy years later. The behaviors are familiar: outsized spending, poor advice, and emotional coping through consumption. Mike Tyson, who once commanded staggering purses and endorsements, later faced bankruptcy, not from a lack of earnings, but from a combination of legal troubles, spending, and the absence of a self-defined limit for lifestyle. These stories underscore a core truth. Having more money amplifies the problem of not knowing what enough means. Greed isn't always personal. Sometimes it's structural and contagious. Corporate and national examples show that when people are rewarded for growth without limits, the result can be spectacular gains, followed by catastrophic losses. Large empires built on relentless expansion can collapse when the culture prizes more over sustainable margins. Iker Batista's rise and fall, at one point one of the world's richest men and later dramatically deposed by debts and failed ventures, shows how empire building, hubris, and overconfidence in the narrative of limitless upside can wipe out fortunes. The lesson is not that ambition is wrong, but that unchecked ambition without prudent boundaries and a margin for error is dangerously close to gambling with your future. The psychology behind never enough is simple and powerful. Humans are social animals who seek status as a signal of value. Modern capitalism excels at creating new standards to chase: bigger houses, faster cars, rare experiences, and social media accelerates comparison. Each incremental success invites a new comparison, and our satisfaction is often determined more by relative rank than absolute comfort. Morgan Housel highlights that stopping the goalpost requires the hardest financial skill: defining what you truly value, and resisting the tide of envy and one-upmanship. Without that self-awareness, saving becomes saving for the approval of others, not for freedom or security. So what does a practical enough look like? First, it starts with clarity. Write down what money is supposed to buy for you: security, time with family, creative freedom, and use that as a North Star. Second, build buffers: emergency savings, insurance, and conservative leverage. Protect against the inevitable shocks that turn ambition into ruin. Third, measure progress by internal metrics: time freedom, health, relationships, rather than external ones: cars, yachts, follower counts. Fourth, cultivate gratitude and ritualize limits: small, repeatable practices that remind you of what you already own and the life you want to preserve. These disciplines don't snuff out aspiration. They channel it into outcomes that actually matter. Finally, the story of Never Enough is not just a warning. It's an invitation. It asks you to define a life that money serves rather than one that owns you. The richest people aren't always those with the largest accounts. They are often the people who wake up with time, dignity, and options. They know that wealth is the ability to do what you want, when you want, with whom you want. If you can name what enough means for you, you've made the most radical financial move possible. You've taken the finish line out of the marketplace and placed it within your own control. That quiet decision is worth more than any headline fortune. Chapter 4. Confounding Compounding. Compounding is the quiet engine behind fortunes, habits, and life changes. It is not glamorous. It does not dazzle with a splashy headline. Instead, it works like a small, patient engine, day in, day out, turning modest returns into consequential results when given the most underrated input of all: time. Viewing money through the lens of compounding changes the questions we ask. Instead of chasing the highest possible return this month, we begin to ask how long we can stay invested, how few mistakes we can survive, and how we can build systems that keep our money working while we live. Nothing shows this truth better than the arc of one of modern investing's most famous practitioners. Warren Buffett began investing as a child, consistently reinvesting earnings and letting wins accumulate. The astonishing fact often repeated is that the vast majority of his net worth came late in life. Decades of compound growth turned earlier gains into the enormous fortune we now associate with his name. That timeline is not a mystical exception. It is a straightforward demonstration of exponential growth. When returns compound year after year, recent gains account for more of the total simply because they compound on a much larger base. The math is plain. The lesson is profound. Time often matters more than the occasional large return. Compound interest is merciless in its fairness. It rewards consistency, patience, and the stubborn refusal to cash out early. Consider two simple stories. Person A achieves a spectacular 20% return for 3 years, then stops investing. Person B earns a steady 8% every year for 30 years. In most realistic scenarios, Person B will dramatically outpace Person A by the end, not because their returns were sexier, but because they let the smaller returns compound for far longer. This is why advisors stress starting early and staying invested. The calendar, not the cleverest trade, usually does the heavy lifting. Real lives make the math humane. I once spoke with a teacher who started investing small amounts from her first paycheck at age 22. She never made headline-grabbing trades or bought into every hot tip. She automated contributions, resisted the urge to time the market, and let the accounts quietly grow. By her late 50s, her modest habit had delivered a sum far larger than anyone who chased flashy returns for a decade and then cashed out in panic. The contrast shows where compounding's real power lies, in endurance, not intensity. It rewards the person who shows up again and again, not the person who burns bright and then disappears. If compounding is patient, our behavior is not. People tinker, they check portfolios daily, they bail at the first sign of trouble, they chase the next big winner. Each trade out of fear or greed interrupts the compounding process. Time in the market beats timing the market, not because the market is always predictable, but because staying invested preserves the sequence of returns that allows compounding to unfold. The practical guardrails are simple. Automate contributions, resist the urge to outsmart volatility, and treat withdrawals as last resort actions rather than routine decisions. Those habits keep compounding uninterrupted. Patience does not mean passivity. It means designing your life so you can remain invested through the bad years. That design includes savings buffers, conservative leverage, diversification, and humility about what you can predict. Compounding requires survival. A decade of compounding does nothing if you are forced to liquidate at a loss due to an emergency or margin call. So the wise investor focuses on two parallel tasks: optimizing for long-term compounded returns and making sure the plan can survive setbacks. One without the other is fragile. Both together are durable. There is also a subtle behavioral truth. Compounding rewards low-drama decisions. The highest returns are rarely the result of perfect foresight. They often come from avoiding catastrophic errors and giving good decisions time to accumulate. Large fortunes are commonly built from a string of modestly good choices, repeated and compounded. That's why humility about performance forecasts and the limits of knowledge is an essential companion to patience. The compounding of ego can be as destructive as the compounding of returns. If you take one practical idea from this chapter, let it be this: prioritize time over timing. Start earlier than you think you need to. Make saving and investing habitual and automatic. Protect your capital with reasonable margins of safety so that you can let compounding do its work. Celebrate steady progress, not spectacular headlines. In the quiet arithmetic of time, small decisions add up to life-altering outcomes. Compounding is not an opinion. It's an invitation to a way of life that rewards patience, endurance, and quiet consistency. Chapter 5. Getting wealthy versus staying wealthy. Getting rich and staying rich are twin ambitions with very different temperaments. One is a sprint. The other is a long, cautious endurance run. Getting rich often rewards boldness, taking big risks, seizing a hot opportunity, betting on yourself when the odds are uncertain. Staying rich asks for the opposite virtues: humility, restraint, paranoia about downside, and an obsession with survival. Confusing the two, treating the habits that made you wealthy as if they alone will preserve it, is one of the most common and costly mistakes in finance and life. History gives us clear, painful examples. Many headline fortunes were built by daring entrepreneurs and gamblers of opportunity, only to be eroded by lifestyle inflation, leverage, or overconfidence. Athletes and entertainers who earned tens or hundreds of millions have filed for bankruptcy because spectacular incomes met spectacular spending and poor protection against shocks. The pattern repeats. High income funds, high consumption, fragile bets are made to sustain status, and a single shock, divorce, legal judgment, tax trouble, or market crash, turns abundance into ruin. These stories are a blunt lesson. The skill that earns wealth is rarely the skill that preserves it. Contrast that with someone who quietly protects capital. Warren Buffett, often cited not simply for how he made his money, but for how he keeps it, emphasizes frugality, margin of safety, and avoiding ruin as central to long-term success. His wealth grew not from constant spectacle, but from a string of durable advantages: patience, buying value with a margin of safety, and refusing to bet the farm. Staying wealthy looks less like heroism and more like 1,000 small guardrails: diversification, conservative leverage, liquid reserves, and the discipline to say no. Those behaviors often look boring until they are not, until markets turn and the fragile are exposed. There is a psychological split at the root of the problem. Getting rich requires conviction and optimism. Staying rich requires humility and paranoia. Optimism fuels creation. It gets you to start a company, raise capital, or quit a job to pursue a dream. But optimism, left unchecked, breeds belief in narratives that deny downside. Paranoia, in the constructive sense, is the sober recognition that what can go wrong will sometimes go very wrong. The wealthy who endure are the ones who treat worst-case scenarios as active threats to be planned for, not unlikely inconveniences to be hoped away. Practical tactics separate the two mindsets. The creator uses concentrated bets and leverage to amplify upside. The preserver spreads exposures and keeps dry powder. The creator accepts volatility as the toll of progress. The preserver builds margins of safety so that volatility does not trigger permanent losses. The creator measures success in milestones and headline metrics. The preserver measures success in survival and optionality, the ability to act calmly when opportunities or crises appear. These are not moral judgments. Both sets of behaviors are rational in their respective games. The mistake is playing the wrong game at the wrong time. Real life also shows how wealth preservation is social and institutional, not merely personal. Family offices, endowments, and wise foundations often emphasize governance, succession planning, and humility about concentration risk precisely because the math of preservation involves time horizons that span generations. Structures that limit impulse, trusts, boards, conservative payout policies are as important as investment returns. Without those guards, even disciplined individuals can see fortunes dissipate through family disputes, poor heirs, or ill-timed gambles. In short, staying wealthy is a systems problem as much as an individual one. What are the life lessons embedded in this difference? First, celebrate the audacity that builds. Respect, but do not romanticize, the humility that preserves. Second, design different rules for different phases. Early on, higher risk may be appropriate. Later, tilt toward preservation. Third, build buffers, emergency savings, conservative leverage, insurance to avoid forced liquidation during crises. Fourth, protect your time and options. True wealth is the freedom to choose, and that freedom evaporates quickly without cautious stewardship. Finally, cultivate the discipline to say no, to leverage, to ostentatious signaling, to bets made for vanity rather than necessity. If there is a single, portable truth here, it is this: wealth is fragile, and its preservation depends less on cleverness than on humility, planning, and the ability to survive. The skills that plant seeds of fortune will not necessarily water them year after year. Honor the appetite for risk that creates possibilities, but when you have something to lose, switch strategies, protect, simplify, and build systems that let compounding and time, not luck or bravado, do the work. Chapter 6. Tails, you win. Tails are the quiet miracles and the quiet cruelties of finance. Most days, investing feels like a long, steady grind. Small gains, occasional losses, the mundane arithmetic of contributions and withdrawals. But the real story is lopsided. A handful of outcomes, a few companies, a few decisions, a few lucky breaks produce the vast majority of returns. Accepting that truth changes everything. It frees us from the vanity of trying to predict every move, and it forces us to build systems that can capture the rare, outsized wins without being destroyed by the many small losses along the way. Empirical research makes the pattern stark. One influential study shows that a tiny fraction of companies account for nearly all net wealth creation in the stock market over long periods. That means that most individual equities underperform the broad benchmarks, and a small number of outliers do the heavy lifting for investors who own broad markets or the right baskets of winners. The practical implication is humbling. You don't need to be right most of the time to succeed. You only need to be exposed to the possibility of being right sometimes. But you also must survive long enough for those rare winners to appear. Venture capital offers a vivid business school example of tails in action. VCs expect many startups to fail. Their hope, indeed their business model, rests on a few massive successes that return a fund many times over. The distribution is brutal. The majority of bets may disappoint, but one or two home runs can make the portfolio. That dynamic explains behaviors across the ecosystem. Why investors tolerate a high failure rate. Why they chase potential unicorns instead of pretty good steady growers, and why timing, network access, and sheer luck can matter as much as judgment. Studies of recent VC periods also warn that when markets get hot, due diligence can suffer and outcomes become even more concentrated in fewer winners. Real lives capture this asymmetry in human terms. Imagine two developers in the same city, both brilliant and hard-working. One joins a nascent startup that, by a mix of product-market fit, timing, and luck, becomes a unicorn and later a household name. The other spends the same years building steady value at smaller companies and enjoys a good middle-class life. The first person's financial story is transformed by that one-tail event: equity that compounds into wealth, opportunities to found new ventures, and the freedom to choose. The second person's life is stable but comparatively ordinary. Neither path is morally superior. They are just different distributions of outcomes in a world driven by tails. Understanding tails also changes how we interpret failure and success. Survivorship bias tempts us to study winners and assume their process is a repeatable recipe. But if outcomes are driven by rare events, the visible winners are an unrepresentative sample. For every success we admire, there are countless unseen attempts that followed the same playbook and failed. That's why mimicry, Copying the actions of heroes without understanding the underlying exposure to tail events is dangerous. What looks like genius in retrospect may have depended on luck no amount of genius can guarantee. So what should an investor, entrepreneur, or saver do with this knowledge? First, accept that many things won't work out, and plan accordingly. That means sizing bets so that failures don't end the game. Diversify where appropriate, build reserves, and avoid leverage that forces premature exits. Second, tilt for optionality. If your life or portfolio can afford a few asymmetric bets, small positions with unlimited upside relative to downside, you increase your chance of catching a tail event without imperiling survival. Third, be patient. Tails often take time to reveal themselves. The compounding of a winner is rarely instantaneous. Fourth, resist the temptation to prune all losers too quickly. Experimentation breeds hits, but you must balance patience with discipline so that experiments don't become ruinous habits. There's a deeper, humane lesson: humility. When you accept that outcomes are often shaped by randomness and rare events, you're less likely to tell heroic stories about individual genius and more likely to build systems that accommodate uncertainty. That outlook makes you kinder to yourself when plans fail, and wiser about the limits of imitation when you study success. It also encourages stewardship. Rather than betting everything on the next headline winner, you design a life where one or two big wins amplify a steady base of financial safety. Tails don't offer a guarantee. They offer a structure for thinking. They let ordinary people build extraordinary results without being extraordinary every day. The trick is simple but profound. Survive the many small misses, own the possibility of the rare win, and keep your life intact until the tails, if they come, can do their work. In a world where a few events drive most of the outcomes, prudence, optionality, and patience are not just virtues, they are the architecture that makes tails work in your favor. Chapter 7. Freedom. True wealth is quieter than most of the stories we tell about money. It is not the headline of a bank balance or the flash of another purchase. True wealth is the unsold, unannounced thing that shows up in the most ordinary moments. The ability to decide how to spend an afternoon, to say no without fear, to choose presence over obligation. Morgan Housel puts it plainly: controlling your time is the highest dividend money pays. That sentence is not a pithy aside. It is the North Star for a life of financial meaning. We spend our lives trading time for money, often assuming the transaction is neutral. But the quality of what we receive in return, autonomy, peace, the freedom to be ourselves, is not guaranteed by income alone. Research into income and well-being shows a clear pattern. Higher income raises life evaluation. We feel our lives are better in broad strokes, but it does not necessarily buy ongoing emotional well-being beyond a certain point. In other words, money can buy comfort, security, and choices, but it can't automatically purchase unhurried mornings or fewer obligations. Those outcomes require intention and deliberate use of money to buy time back from the marketplace. Time affluence, the felt sense of having enough time, is increasingly studied as a distinct dimension of well-being. People who report greater time affluence also report higher life satisfaction, lower stress, and more meaningful social connections. The paradox is that the tools of modern life that promise efficiency often steal time through invisible obligations, multitasking, and the constant pressure to be productive. Money becomes most valuable when it's spent to restore what modern life takes: unscheduled hours, restful presence, and the ability to choose. That's why some of the wealthiest people you meet aren't the calmest. They simply chose not to buy back the one thing money can't create: extra hours in a day. Real life makes these ideas concrete. There are engineers who took lower-paying jobs with flexible hours to be parents in the mornings, and later described those sacrificed dollars as the best investment they ever made. There are founders who sold companies not because they needed the money, but because they wanted to stop being defined by an always-open inbox. There is a movement of people pursuing financial independence precisely because it buys them options: the freedom to freelance, to volunteer, to spend afternoons with aging parents without checking a calendar. The Rising Fire movement is a social proof that many value autonomy above headline income and are willing to trade consumption today for decades of self-direction tomorrow. But freedom is not a single act of cashing out. It's a design problem. Some people obtain financial flexibility by reducing expenses and increasing savings. Others build optionality through part-time work, passive income, or entrepreneurial ventures that allow them to scale down without collapsing. The common thread is intentionality, treating money as a tool to buy control over your schedule rather than as a signal to buy more things. Practically, that means identifying what you want your days to look like, estimating the cost of reaching that level of autonomy, and aligning saving and spending to that goal, rather than to social comparisons. It's less about a number in an account and more about a set of options you can realistically exercise. There's also a humility embedded in choosing freedom. The pursuit of more for its own sake often increases obligations: larger homes, more expensive schools, endless social signaling, which in turn make you dependent on a higher and higher income. The vicious cycle tightens your schedule rather than loosening it. Conversely, people who deliberately limit consumption keep their lives more resilient. They can take sabbaticals, change careers, and respond to crises without panic because their freedom is not tethered to a single paycheck. Freedom bought with restraint is more durable than freedom bought with hubris. If you want one practical takeaway, try a simple exercise. For a month, catalog moments when money would buy you time. Was it hiring help for house chores? Turning down a social obligation that drains you? Reducing commute time by working closer to home? Then estimate what those trades would cost and which ones would most improve your day-to-day life. Use that map to make choices deliberately. Spend to purchase hours that feel priceless, and resist spending that merely buys status or temporary distraction. Over time, those choices compound into real freedom. In the end, wealth is a means to a life, not the life itself. The highest dividend money pays is not interest or capital gains. It is the quiet economy of your time. When you treat money as the instrument that buys you autonomy, the power to choose where your attention goes, you discover the truest form of financial return: waking up and deciding, without guilt or calculation, how you will spend the day. That is freedom. That is wealth. That is, for many, the point. Chapter 8. Man in the Car Paradox. I once worked a summer job that taught me a lesson no finance textbook did. People rarely admire the person sitting in a flashy car. They admire the car, and they imagine themselves in it. That simple observation is the heart of the man in the car paradox. We buy expensive things to signal status and earn respect, but the attention those things attract is aimed at the thing, not the owner. The result is a hollow victory, a headline of admiration that never quite lands on the life you live. At first, this reads like vanity's indictment, but it's deeper than vanity. It's rooted in human psychology. Costly signaling theory explains why conspicuous consumption exists. Expensive, hard-to-fake possessions serve as signals of resources and status. Those signals can influence social standing, mating prospects, and access to networks. Yet costly signals are blunt instruments. They alter perceptions of an object more reliably than perceptions of a person. When you admire a watch, a house, or a car, you are often measuring that object against a personal fantasy of what your life could be, not evaluating the character or the choices of the owner. The paradox is that signal receivers tend to project themselves into the possession rather than projecting admiration outward to the possessor. Real life offers many quiet tragedies that blossom from this mismatch. People who spend to impress find themselves chained to the illusions they bought. Larger mortgages that demand longer hours, social circles that expect ever bigger demonstrations, and a fragile identity that rests on things that can be sold or repossessed. Meanwhile, those who quietly build wealth without announcing it, who invest in time, relationships, and optionality, often enjoy more durable returns. The neighbor who sees the flashy sports car arriving at a party may briefly glance, but the friend who shows up with steady generosity, time, and integrity is the one who earns real regard over years. There's also a behavioral economics angle. The utility we think we'll get from status purchases is often overestimated. We imagine the social uplift and the inner satisfaction a purchase will bring, but adaptation and shifting reference points quickly dilute those feelings. A new car's novelty fades, the social benchmark moves. The next purchase is needed to maintain the same feeling. Morgan Housel's point is practical. Buying status often trades future freedom for present signal. The highest return on money is rarely measured in immediate applause. It is measured in options, time, and peace. How should that insight change how you use money? First, define the life you actually want, not the life you imagine other people admire. If admiration is a motive, ask whether the cost of the signal, time worked, leverage taken, emotional strain, is worth the fleeting reaction. Second, invest in invisible wealth, savings, relationships, health, and time. These assets offer returns that compound into freedom rather than into social noise. Third, design commitments that protect your priorities. Reduce status spending, automate savings, and ritualize small acts that reinforce the life you value rather than the life you perform. There's a subtle social grace in resisting the paradox. When you stop buying to be admired, you reclaim attention for what matters: curiosity, generosity, competence, and steadiness. People remember how you made them feel and what you did for them more than the brand of your car. The paradox doesn't forbid pleasures or luxury. It asks us to be intentional. Spend on things that bring real utility or joy, not on objects that exist mainly to be seen. That discipline keeps your options open, your time yours, and your dignity independent of the next headline purchase. If you want a single practical test before any big purchase, try this. Imagine you sell the item tomorrow. Would you miss it because of its function and the life it enables, or because of the attention it produces? If the latter, you're buying theater. If the former, you're buying value. Learning to prefer the second answer is a small shift with outsized returns, not in likes or glances, but in a life that's richer for being owned by you rather than being performed for others. Chapter 9. Wealth is what you don't see. Wealth is invisible. It's not the shiny objects that parade down a driveway or the curated images in someone's social feed. Real wealth lives in bank accounts, in unbought cars, in choices preserved for another day. It is the absence of an expense rather than the presence of a purchase. That simple inversion, that wealth is what you don't see, changes how we measure success and reshapes the decisions that lead to financial freedom. When you watch a luxury car pass by, you admire the car. When you meet the owner, you rarely feel the same admiration for the person. What you notice is the signal the object sends: status, taste, or access. But signals are one-way mirrors. They make the object visible and the owner invisible. People who spend to be seen trade future optionality for momentary applause. Those who withhold convert today's desires into tomorrow's flexibility. Seeing wealth this way helps explain why high earners can be financially fragile while modest earners can be comfortably secure. Economists and behavioral researchers call attention to a visibility bias in social transmission. Consumption is easy to observe, saving is not. When people learn how others live, they disproportionately see spending. That creates a contagion of consumption, a sniff of social proof that nudges people to match visible lifestyles. The result is a world where the appearance of wealth is often mistaken for wealth itself. Policies and personal norms that rely on observation alone therefore misread who is actually secure and who is merely signaling. Recognizing that bias is the first step toward changing the habits that keep cash where it should be. Working for you. Real life offers sharp contrasts. Consider two neighbors. One drives an expensive car, hosts lavish parties, and seems to live a life of ease. The other keeps a modest car, declines invitations to splurge, and looks unremarkable. Years later, the ostentatious neighbor faces debt collectors after a job loss, while the modest neighbor quietly declines early retirement offers and keeps choices open because of an unspent nest egg. The outward signal misled the onlookers. The visible splendor masked leverage, obligations, and a fragile lifestyle. The invisible nest egg bought time, the one luxury money cannot manufacture at the point of sale. Famous examples reinforce the lesson. Many of the world's wealthiest people live simply: modest homes, ordinary cars, and a reluctance to advertise wealth. The habits of disciplined savers and frugal investors, living below means, prioritizing savings, and avoiding flashy consumption, compound into options over decades. Warren Buffett's longtime residence in a modest Omaha house is less about quaintness and more about a philosophy. Spend less than you earn and let the difference work for you. That invisible capital pays dividends not measured in applause, but in freedom. Understanding that wealth is invisible also frees you from two destructive impulses. The first is imitation, copying the visible behavior of others under the mistaken belief it will produce the same results. Because the true source of someone's financial position is often hidden: inherited assets, concentrated windfalls, or conservative habits, mimicry can lead to ruin. The second impulse is signaling, spending to craft an identity. Signals wear out quickly. They require escalation. The lifestyle treadmill demands ever greater expenditures to maintain status. Escape both traps by making your financial metric private and purposeful. Measure progress in options created, not objects purchased. Practical steps flow naturally from the idea. First, treat not buying as a form of investment. When tempted by a purchase, ask what options that money could create in 5 or 10 years. Second, automate saving so the invisible work of wealth accumulation happens without daily drama. Third, reduce visible consumption that costs more in time and opportunity than it returns in joy. Fourth, practice a sell-it-tomorrow test. Before a big buy, imagine selling it next week. If the imagined sale hurts more because of attention you'll lose rather than usefulness, you're probably buying theater, not value. These habits convert fleeting desires into durable security. Finally, think of wealth as the architecture of freedom. Objects can be stolen, trends fade, and admiration is fickle. But the life you can design with invisible assets, the ability to change careers, to take time with family, to withstand shocks without panic, is a return that compounds in ways no flashy purchase ever will. If you want to build a life that lasts, start by valuing what you don't see. Chapter 10. Save money. Saving is an act of empowerment more than abstention. It is the decision to convert present consumption into future options, options that buy time, choice, and resilience. Whereas markets and asset selection are uncertain and often outside our direct control, the portion of income we set aside is a lever we can pull reliably. That leverage is why your savings rate, the percentage of income you habitually save, frequently matters more than your headline salary or the exact return your portfolio achieves. When you control how much you save, you control the pace at which opportunity and protection accumulate. The arithmetic is blunt and instructive. Two people earning the same amount can have dramatically different long-term outcomes if their saving behaviors diverge. A modest increase in the savings rate compounds through time far more predictably than chasing marginally higher market returns. For shorter and medium-term goals especially, incremental contributions shift the timeline to independence more than theoretical improvements in annualized returns. That is why financial planners and institutions emphasize the simple discipline of saving before optimizing asset allocation. You cannot invest what you do not first set aside. There is also a practical psychology behind effective saving. Pay yourself first is not a slogan, it is a behavioral design. By automating transfers to savings or retirement accounts the moment wages arrive, before discretionary spending, you convert intention into habit and remove the friction that causes people to spend what remains rather than save what matters. Tactics such as payroll split deposits, automatic transfers to investment or emergency accounts, and incremental increases in contribution rates after raises turn saving from an occasional act into an identity. Over time, those small, seemingly mundane moves build a margin of safety that allows for bolder choices later. Real lives illustrate how this plays out. Consider a mid-career professional who implemented a rule. 20% of every paycheck goes directly into savings and investments. This person declined a few conspicuous upgrades, a larger house, a newer car, and instead accumulated a liquid buffer and investment base. When an unexpected opportunity to change careers arose, the buffer allowed a deliberate transition rather than a frantic pivot. Contrast that with a peer who matched nominal lifestyle to income increases and had little liquidity. When disruption came, the peer sold assets at poor prices or incurred expensive debt. The difference was not talent or luck alone, but the willingness to prioritize savings over signaling. Saving also buys optionality in markets. When you have cash or liquid reserves, you can wait for better entry points, endure market drawdowns without panic selling, and take advantage of opportunities that require patience. Behavioral research shows that markets reward those who can remain invested through volatility. Savings provide the runway to do exactly that. However, there is a balance to strike. Holding excessive idle cash for too long erodes purchasing power and opportunity. So integrate emergency reserves with a longer-term investment plan that reflects your horizon and risk tolerance. You do not need a precise, singular reason to save. Saving for saving's sake is rational because it creates universal currency, optionality. Specific goals are helpful: home down payment, education, retirement, but a general savings habit builds the flexibility to choose among opportunities and absorb setbacks. Practical frameworks, reverse budgeting, the 80-20 or 50-30-20 rules, and the practice of escalating savings with income increases help make this sustainable. The most reliable approach is the one that removes choice friction. Automate, escalate, and treat saving as a primary commitment, not an afterthought. There are policy and structural levers too that amplify individual saving. Employer retirement plans with automatic enrollment and matching measurably increase accumulation. Governments and institutions that provide tax-advantaged accounts or nudges can materially improve outcomes for many households. Where such tools exist, use them. Where they do not, replicate their effects with automatic personal systems and rules. Concrete rules that work in practice. Treat saving like a recurring bill and pay it first. Set a target savings rate and track it as your primary progress metric. Build an emergency cushion equal to several months of living expenses before taking significant market risks. Increase savings with pay raises rather than lifestyle inflation. And periodically review allocations so your cash management supports both resilience and growth. These are not glamorous prescriptions, but they are the architecture that makes financial freedom attainable and durable. If there is a single practical idea to take away from this chapter, it is this: focus on what you can control. You cannot dictate market returns or the timing of economic shocks, but you can decide how much of your income you defer to the future. That decision builds options, reduces panic, and lengthens your runway for compounding to work. Over a career and a lifetime, the calm arithmetic of consistent saving will often outpace the drama of headline investment picks. Prioritize the savings rate, automate it, protect it, and let it buy you the most valuable returns of all: time, choice, and peace of mind. Chapter 11. Reasonable, Rational. Reasonable is the bridge between human nature and sound finance. Rationality, in its pure mathematical form, presumes a frictionless mind, decisions detached from fear, pride, habit, and the messy contingencies of life. Reality is messier. Emotions, identities, and social pressures shape what people will actually do with money. A technically optimal plan that a person cannot follow is worthless. A slightly suboptimal plan that they can live with is powerful. The central proposition of this chapter is simple but consequential. Design financial choices that are reasonable for you, defensible under stress, sustainable over decades, and aligned with how you actually behave. Behavioral science explains why this distinction matters. People do not make financial choices after a cool, clinical calculation. They make them in the middle of stressful market declines, during family transitions, and under social pressures. Loss aversion, recency bias, and the disproportionate power of anecdotes push otherwise sensible individuals into actions that sabotage long-term goals. Studies of financial behavior show that commitment devices and simple defaults, payroll deductions, automatic escalation of contributions, and default enrollment in retirement plans dramatically increase saving and adherence because they circumvent daily temptation and emotional volatility. In short, design the environment so reasonable choices become the default. Consider two hypothetical investors. The first builds a portfolio optimized by every textbook metric, then watches it fall 40% in a single year. Panic sets in. They sell at the bottom and miss the subsequent recovery. The second chooses a slightly more conservative allocation of assets that they are emotionally comfortable holding through downturns. When markets fall, they sleep. Over decades, the second investor's ability to remain invested and to add to positions during dips produces superior realized returns, not because their allocation was mathematically superior in expectation, but because it was sustainable in practice. Empirical analyses of market timing show how costly attempts to outsmart markets are. Attempting to time exits and re-entries frequently destroys value because the best days are often concentrated in short windows that are easy to miss. The lesson? Prefer plans you will stick with when it counts. Real lives reinforce the point. Financial advisors report that clients who are forced into decisions by crises, layoffs, medical bills, or sudden market drawdowns often act counter to their stated long-term objectives. Advisors who acknowledge and plan for clients' emotional responses by predefining reaction rules, building larger emergency buffers, or creating glide paths that shift exposures gradually help clients stay the course. That human-centered approach reduces regret, improves outcomes, and strengthens the client-advisor relationship. The most resilient plans are those that anticipate human weakness and neutralize it with structure. Reasonable also reframes trade-offs. A strictly rational investor might choose maximal expected return regardless of volatility. A reasonable investor calibrates returns against psychological endurance and life circumstances. If an allocation keeps you awake at night, its theoretical advantage is irrelevant. Conversely, modest concessions in expected return can be worthwhile if they preserve follow-through. Practically, this means accepting that financial plans are part engineering, part psychology. Good plans combine mathematical soundness with behavioral tolerability. That duality governs saving behavior, asset allocation, retirement withdrawal strategies, and even how you manage debt. How to translate reasonable, rational into actionable steps. 1. Default to habits that remove choice friction. Automate savings, use direct deposit splits, and enroll in employer retirement plans with escalation. These reduce the need for willpower and make good outcomes automatic. 2. Build buffers. An adequate emergency fund prevents forced liquidations and guards against panic-induced errors. Size the cushion to your life stage and liability profile. 3. Stress test your plan emotionally. Imagine extreme scenarios: a 4% drawdown, job loss, divorce, and ask whether you can adhere to the plan under those conditions. If not, adjust to a version you can own. 4. Adopt pre-committed rules for behavior, rebalancing schedules, contribution hikes on raises, and pre-planned thresholds for selling reduce ad hoc decisions driven by emotion. 5. Prefer optionality over maximality. Where possible, design choices that keep future options open rather than forcing irreversible paths for marginal gains. The broader moral is humane. Financial advice should meet people where they are, not where an idealized model thinks they ought to be. Reasonable plans respect human psychology. They are explicit about trade-offs and honest about limitations. They aim to produce outcomes that people can live with, not just defend in a spreadsheet. Finally, Competency in money is less about perfect forecasts than about constructing a life you can maintain. The highest performing financial strategy is worthless if you abandon it at the first real-world test. If you leave this chapter with one conviction, let it be this: design for durability. Choose financial actions that are both sensible and bearable. That marriage of prudence and practicality, being reasonable rather than merely rational, is the foundation of personal financial success. Chapter 12. Surprise. Surprise is the rule, not the exception. Markets, economies, and personal lives are shaped as much by events no model predicted as by those we expect. The history of finance is crowded with moments that felt obvious only after they happened. A housing bubble that had quietly inflated for years, a pandemic that halted commerce and collapsed markets in weeks, a technological revolution that remade entire industries. Accepting that the most consequential events are often surprises changes how we prepare. It shifts the question from "what will happen" to "how will I endure what I can't foresee?" Nassim Taleb's idea of the black swan captures this plainly. Rare, high-impact events are inherently unpredictable and then rationalized in hindsight. The practical lesson is not to curse uncertainty, but to design systems that are robust to it, to build financial plans that survive the improbable and, where possible, benefit from disorder. That means embracing humility about forecasting and privileging structures that protect capital, preserve optionality, and keep you in the game when extremes arrive. Modern history supplies stark examples. In 2007 to 2009, a cascade of failures in housing finance and shadow banking produced a global financial crisis that few participants fully anticipated, and many models failed to price. The crisis crushed wealth, disrupted livelihoods, and reshaped regulation and risk management for a generation. More recently, the rapid market collapse in March 2020, triggered by the COVID-19 pandemic, demonstrated how quickly an apparently stable expansion can reverse when a real-world shock combines with fragile market internals. These episodes are not theoretical footnotes. They are reminders that tail events arrive and can be catastrophic when financial plans lack buffers. If surprises drive outcomes, resilience is the central aim of prudent planning. Resilience has several practical dimensions. First, liquidity. An emergency fund and readily accessible reserves let you avoid selling into panics and give you time to make rational decisions. Second, margin of safety. Conservative sizing of bets, adequate insurance, and avoidance of catastrophic leverage prevent single events from ending your plan. Third, diversification and optionality. Distributing exposures across assets, time horizons, and income sources reduces the chance that one shock destroys everything, while small asymmetric bets preserve upside without risking ruin. Fourth, governance and rules. Predefined policies for rebalancing, drawdown responses, and non-emergency withdrawals remove the need for crisis-driven improvisation. These are not glamorous prescriptions, they are structural defenses that allow compounding and patience to continue working when the unexpected arrives. Real people illustrate why these defenses matter. Families with several months of living expenses in reserve navigated layoffs, health crises, and income gaps without debt traps. Investors who kept leverage modest rode out severe market drawdowns and participated in recoveries. Those who chased yield with high leverage often faced forced liquidations at the worst possible times. Firms and financial institutions that emphasized liquidity and conservative risk limits survived episodes that toppled more aggressive competitors. The common thread is simple. Survival begets opportunity. If you are still standing after a surprise, you can benefit from the eventual recovery. If you are not, no strategy can help. Preparing for surprise is partly technical and partly behavioral. Technically, build and maintain an emergency buffer sized to your circumstances. Avoid concentrated leverage that can trigger margin calls. Diversify across uncorrelated exposures where feasible, and maintain insurance appropriate to your risks. Behaviorally, cultivate humility and discipline. Assume your forecasts are fallible, resist narratives that normalize ever-rising prices, and establish pre-commitments, automation, rules, and checklists that limit emotional decisions during stress. Warren Buffett's emphasis on protecting capital, a constant refrain in his letters, is not academic. It is a behavioral posture that prizes endurance over headline returns. Surprises will continue to come in forms we cannot enumerate. Some will be systemic, some personal. That reality makes two attitudes valuable. First, adopt a posture of preparedness. Treat optionality, liquidity, and margin of safety as first-order objectives. Second, cultivate long horizons and patience. Most recoveries play out over years, not weeks. The advantage goes to those who can stay invested and act intentionally rather than react out of fear. The work of financial prudence is therefore less about predicting the next shock and more about ensuring you can absorb it without losing the capacity to recover afterward. Finally, surprises teach a moral lesson about humility and stewardship. Accepting unpredictability reduces hubris, discourages concentration of risk, and encourages generosity when fortune allows. It forces us to ask, if shock comes, who will bear the burden? Just me, my family, or many others? Designing plans that preserve dignity in adversity and that avoid imposing ruinous risk on dependents and partners is both prudent and ethical. In short, expect the unexpected, protect what matters, and prioritize the structures that let you survive, and act when surprises arrive. Money's true power is not in forecasting certainty, it is in buying the time and the options to respond well when the world, as it always does, surprises you. Chapter 13. Room for Error. Margin of safety is the quiet architecture of financial survival. It is the deliberate space you build into your plans so that when life bends, and it will, your finances bend with it rather than break. Margin of safety is not an abstract virtue. It is a concrete set of habits, buffers, and rules that reduce the chance that a single adverse event will derail years of compounding. Without it, even mathematically superior strategies can fail because reality rarely follows the clean assumptions of models. At its core, margin of safety acknowledges two unavoidable facts. Forecasting is imperfect, and shocks happen. No matter how careful your analysis, you will be surprised. Markets decline, businesses falter, health issues arise, and opportunities evaporate. The question for long-term success is not whether bad things will occur, they will, but whether your financial plan can endure them. A buffer gives you the endurance to survive, and survival is the precondition for compounding, for recovery, and for future opportunity. Practical margins take many forms. The simplest is liquidity, an emergency reserve that covers several months of essential expenses. That fund prevents you from liquidating investments at inopportune moments or taking on high-cost debt when income falters. Another form is conservative sizing of commitments. avoiding excessive leverage in investments or mortgages that stretch your cash flows to the breaking point. Insurance. Health, disability, property is a formalized margin of safety. It transfers catastrophic risks away from your balance sheet. Diversification spreads exposures so that a concentrated failure does not translate into ruin. Governance tools like trusts, contingency plans, and shared decision rules create institutional margins that protect families and businesses from impulsive, catastrophic choices. Real lives illustrate how margins matter. I have met entrepreneurs who built fast-growing companies on generous credit lines and investor enthusiasm. When a downturn tightened funding, those who had preserved conservative operating reserves and limited fixed costs weathered the correction and emerged stronger. Those who had maxed out leverage and expanded fixed obligations faced painful restructurings or liquidation. The difference was not that one group was smarter in prosperity, it was that one group designed for adversity before it arrived. In other words, endurance won, where bravado failed. Historical examples are instructive as well. Corporate disasters often trace back to a neglect of buffers. Firms that chased aggressive growth without adequate capital cushions, or that financed long-term projects with short-term debt, found themselves forced into fire sales when markets turned. By contrast, organizations that emphasized capital conservatism, clear contingency plans, and conservative payout policies survived multiple cycles and captured opportunities created by others' distress. The private investor's lesson mirrors the institutional one. Conservative structures create optionality when others are paralyzed. There is a psychological dimension to building margin of safety. Conservatism in finance is often derided as timid. Yet prudence is not the absence of ambition. It is ambition with a survival plan. Building margins requires humility, acknowledging what you do not know, and discipline, because margins often feel like foregone returns in boom times. It feels frustrating to hold cash during a long bull market or to decline a seemingly irresistible growth bet. That discomfort is precisely the point. Margins cost you a bit of potential upside in exchange for vastly reduced downside. Over decades, that trade-off often produces superior realized outcomes because it prevents catastrophic loss and allows compounding to continue. How large should your margin be? That depends on circumstances, your career stability, dependence, leverage, obligations, and risk tolerance. A young, single professional with a stable income and few liabilities may require a smaller short-term reserve than a household supporting children with uncertain health needs. Business owners whose revenues are cyclical need larger operating buffers than salaried employees. The prudent approach is to size margins relative to the plausible worst-case scenarios you might face and then to err on the side of conservatism. In practice, many advisors recommend an emergency cushion covering several months of living expenses, modest leverage relative to assets, and insurance adequate to protect against severe personal catastrophe. There are concrete rules that make margins reliable. Automate contributions to separate reserves so you cannot spend the buffer by accident. Use laddered maturities for fixed income holdings to combine liquidity with return. Avoid rolling short-term liabilities to finance long-term assets. Revisit your buffers when your life changes, marriage, children, new business, and adjust accordingly. Predefine withdrawal rules for volatile markets so you do not liquidate during declines. These structural rules convert prudent intent into durable practice. Finally, remember the moral argument for margin of safety. Financial buffers protect not only your plans, but the people who depend on you. A household with reserves preserves dignity for its members when adversity arrives. A business with contingency plans preserves jobs and livelihoods. Margin of safety is therefore an ethical stance as well as a technical one. It recognizes that risk is not borne evenly and acts to reduce the likelihood that misfortune becomes catastrophe. In the architecture of lasting wealth, margin of safety is the foundation you seldom notice until you need it. It is the quiet, unglamorous choice to prefer durability over headline returns, to pay a small insurance premium in exchange for the ability to remain and rebuild. Compounding requires time. Margin of safety buys you that time. Build it deliberately, protect it zealously, and treat it as the essential condition for every other financial aspiration. Chapter 14. You'll change. Change is the steady current beneath every financial plan. Goals that feel vivid and immovable at one stage of life often soften, mutate, or disappear as circumstances, tastes, and responsibilities evolve. The core risk is not uncertainty in markets. It is committing to irreversible financial choices that suit your present self, but may trap your future self in regret. This chapter argues for designing finances with the assumption of change. Small, deliberate margins that preserve optionality, choices that are reversible, and decisions that anticipate who you might become. People commonly misjudge the persistence of their present preferences. Young professionals prioritize accumulation and status. Parents prioritize safety and predictability. Those approaching retirement prioritize peace of mind and health. Research and surveys repeatedly show how frequently individuals express later life regret about prior financial choices, especially around insufficient saving, early claiming of retirement benefits, and neglected long-term protections, precisely because their earlier plans failed to account for future realities. This is not merely anecdotal. Systematic studies of financial regret among older adults find consistent patterns of wishing they had prepared differently for longevity, care needs, and the psychological shifts that accompany aging. Real life delivers stark examples. The early retiree who spends aggressively in their 30s only to discover in their 40s that their sources of meaning and social connection were tied to work. The entrepreneur who takes extreme leverage to scale quickly and then cannot pivot when market conditions change. The couple who commits to a large mortgage to chase a lifestyle and later finds the monthly obligations crowd out childcare, education, or career transitions. Advice columns and retirement studies highlight recurring mistakes in movements like FIRE, underestimated healthcare costs, social and psychological misalignment, and over-reliance on optimistic return assumptions. These are not moral failings, but predictable errors that arise from treating current preferences as permanent. Designing for change is practical, not fatalistic. Start with reversible commitments. Favor leases, trial periods, phased expansions, and staged investments over all-in moves that are costly to unwind. When buying a home, consider whether the mortgage and maintenance will feel tolerable if incomes fall or family plans shift. When joining a startup or embarking on an intensive career path, maintain a liquidity cushion that lets you experiment without jeopardizing your baseline security. These structured flexibilities transform bold choices into informed experiments rather than irreversible bets. Second, institutionalize periodic reviews. Human preferences drift slowly but surely. Review routines, annual financial audits, mid-career planning sessions, or 5-year strategic reviews force recalibration. Treat plans as living documents. Update them when relationships change, health changes, or when career trajectories alter. Behavioral evidence shows that people who set specific, revisited goals and simple rules save more and make better decisions over time. The discipline of planned reappraisal reduces the temptation to double down on outdated commitments. Third, preserve optionality through margins and buffers. A modest emergency reserve, conservative leverage, and diversified income sources are the practical insurance that lets you alter course when preferences do. Studies of saving regret emphasize that many older adults wish they had deferred certain luxuries in favor of greater flexibility later. Margins buy you the time to discover, without ruin, what you truly value. Small sacrifices in peak short-term consumption can yield outsized gains in future choice architecture. Fourth, use staged escalation rather than headline commitments. Automate savings increases tied to raises. Test new lifestyles for a year before committing, and structure business growth in phases that preserve the option to pause. Structuring commitments as step functions, not cliff edges, reduces regret and keeps future selves empowered. Adopt decision rules that explicitly consider reversibility. Before a large purchase or a career leap, ask, if this no longer fits me in 5 years, how costly will it be to unwind? Finally, cultivate anticipatory humility. Accept that your tastes, health, social networks, and obligations will change. Financial humility is different from pessimism. It's the sober acknowledgement that the future contains unknowns about which you should be prudently flexible. Practical tools that embody this humility include sufficient liquidity, modest leverage, insurance for catastrophic risks, and a bias toward options that preserve mobility rather than lock you into a static trajectory. Life lessons are simple and actionable. Define financial goals, but keep them provisional. Prioritize flexibility over signaling. Design safety margins, not because you expect failure, but because you expect evolution. When you align your financial architecture with the reality that you will change, you make better decisions today and avoid the most common source of regret tomorrow. That orientation, modest, reversible, and resilient, is the hallmark of financial wisdom. Chapter 15. Nothing's free. Every reward in finance carries a price. The higher the expected return, the more you must be willing to tolerate the attendant pain. Sharp drawdowns, prolonged uncertainty, and the temptation to act when action is most costly. Volatility is not a random nuisance. It is the fee you pay for higher returns. Accepting that fee as an intentional cost rather than an accidental punishment is the first step toward designing durable financial lives. The logic is straightforward and empirically grounded. Equities offer an equity risk premium precisely because they are riskier than short-term government debt. Investors require compensation for bearing that uncertainty. That compensation appears over long horizons, but it arrives unevenly. Markets may hand out large gains in some years and severe losses in others, and the sequence matters. The math of expected return is only realized by those who remain invested through the worst chapters, which is why volatility is, in effect, the price of admission to superior long-term returns. Warren Buffett has long driven this point home. Volatility, by itself, is not the same as permanent loss. price fluctuations are part of the terrain. The real risk is being forced to sell at the wrong time. Investors who understand volatility as an intrinsic cost of higher expected returns use it to their advantage. They buy when prices fall and hold when markets recover. That stance requires temperament and preparation. Without them, volatility becomes a tax on outcomes, paid in panic sales, margin calls, or premature withdrawals. History offers stark evidence. The global financial crisis of 2008 to 2009 produced severe drawdowns across asset classes and destroyed wealth for many who were over-leveraged or lacked liquidity. Yet those who preserved capital, maintained reserves, and stayed invested captured much of the subsequent recovery. The difference was not clairvoyance, it was endurance. Volatility punished the unprepared and rewarded the patient. Understanding that pattern reframes the experience of loss. Brief capitulations compound into catastrophe. Measured persistence compounds into opportunity. This principle has two practical consequences for how individuals and institutions plan. First, treat volatility as an explicit cost to be budgeted and managed, not as an error to be eliminated. You cannot remove market volatility without sacrificing expected returns. Moving into cash or ultra-short instruments reduces volatility, but also expected growth. The sensible alternative is to calibrate exposure. Match the risk profile of your portfolio to the size of your margins and the durability of your time horizon. Younger investors with long horizons can accept greater short-term volatility because they have time to recover. Those close to spending horizons need lower volatility or a larger liquid buffer. Second, build systems that let you live through volatility. Practical measures include diversification across asset classes and geographies, conservative use of leverage, adequate emergency reserves, and rules that automate discipline, automatic contributions, rebalancing thresholds, and predetermined withdrawal rules. Advisors add particular value in turbulent times by acting as behavioral buffers, reminding clients of objectives and discouraging emotion-driven departures from plan. In short, designed to endure so you can benefit from the long-term premium that volatility buys. Real lives bring these prescriptions into relief. I once interviewed an engineer who had invested steadily through the 2000s and 2010s. During the 2008 collapse, her portfolio fell dramatically, but her prearranged plan, an emergency fund, no high-cost leverage, and automatic monthly contributions meant she did not sell. She later described the decision to hold and add as the most consequential financial choice of her life. By contrast, a peer who had used credit to finance conspicuous consumption sold equities at the trough and only re-entered years later. The cost was not merely financial, it was the lost optionality to change careers and to retire early. These stories are not exceptional, they are the lived arithmetic of volatility. There are also subtler lessons about perception and language. Thinking of volatility as a fee reframes the emotion it provokes. Fees are expected and accounted for. Fines incite anger and regret. When we view large drawdowns as fines for recklessness, we tend to double down on short-term avoidance strategies that reduce expected outcomes. When we view them as fees for higher expected returns, we accept them in pursuit of long-term objectives and budget for their cost. To translate these ideas into action, adopt a simple checklist. Define the returns you need and the volatility you can tolerate given your time horizon and liabilities. Build a reliable cash cushion, sized to your life stage so you are not forced to liquidate in downturns. Use diversification and conservative leverage to reduce the chance that any single shock is fatal. Automate savings and investing to remove emotional timing decisions. Establish and commit to rules for rebalancing and withdrawals so decisions during stress are preordained rather than improvised. Volatility will remain an inescapable part of the financial landscape. The choice is whether you will treat it as a cost to be paid consciously, budgeting reserves, tempering leverage, and preserving optionality, or whether you will be surprised and punished by it. Accepting the price of volatility is not resignation. It is the strategic posture that lets the arithmetic of markets work for you rather than against you. The true test of financial skill is not removing uncertainty, but arranging your life so you can endure it and ultimately benefit from the premium it confers. Chapter 16. You and Me. People live in different financial universes. Two neighbors might earn similar salaries, yet make radically different choices because they are playing different games. One is saving for early retirement. Another is building a business that requires reinvestment. A third is maximizing liquidity to support an unpredictable income. And a fourth is minimizing risk to provide for dependence. Mistaking someone else's moves for a universal formula is a common and costly error. The essential discipline is simple. Define clearly the financial game you are playing, its objective, its time frame, its allowable risks, and measure your decisions against that map, not against someone else's scoreboard. At first blush, this sounds obvious, yet social pressure, visibility of consumption, and the human impulse to mimic success combine to blur the lines between games. Social feeds display milestones without context, a friend's down payment, an influencer's early exit, an entrepreneur's windfall. Observers see outcomes, not the constraints, trade-offs, or objectives that produce them. That leads to two frequent mistakes. The first is imitation, copying visible behaviors that do not map to your goals. The second is envy-driven escalation, shifting your own game to compete on someone else's terms, often at the expense of long-term priorities. Both undermine the slow, quiet accumulation that durable financial success requires. Consider two plausible life stories. The first is a teacher who values stability and time with family. Her priority is secure income, reasonable hours, and a predictable retirement date. She avoids concentrated stock bets and invests in diversified, lower volatility portfolios, sacrificing some expected return to preserve calm and predictability. The second is a founder in his 30s pursuing rapid company growth. He takes concentrated risk, leverages outside capital, and accepts long stretches without pay because his goal is a transformative exit. Which one is doing it right? Neither and both. Each is optimizing for a different objective. The teacher's strategy would be painfully conservative for the founder. The founder's approach would be reckless for the teacher. The moral is not relativism. It is alignment. Your finances should be coherent with the life you want to lead. Time horizon is a central axis separating games. Short horizons favor liquidity and low volatility because you cannot afford to be forced into sales by a market wobble. Long horizons allow concentration, illiquidity, and risk-taking because time can smooth outcomes and allow compounding to work. Similarly, goals determine risk tolerance. Saving for college in 5 years demands a different plan than building a multi-decade endowment. Recognizing your horizon and making choices that reflect it turns noise into signal. It reduces the temptation to trade away resilience for the chance of a slightly higher return that may never pay out within your required time frame. Risk tolerance is another critical differentiator. Two people with identical financial circumstances may have very different psychological capacities to endure drawdowns. One may sleep through a 30% market decline and increase contributions. The other may panic and sell, locking in losses. Both responses are natural. One is better suited to long-term accumulation. That is why reasonable rational matters. Choose exposures that your temperament allows you to hold. The correct allocation is not the one with the highest theoretical expected return. It is the one you can live with when the market tests your resolve. Goals can change, and so can the games. A phase-based approach recognizes that life is sequential. Early career is often about accumulation and optionality. Mid-career may ask for protection and leverage, and later life prioritizes income stability and legacy. Designing adaptive rules, automatic reallocation as goals shift, staged increases in savings, or pre-specified liquidity targets before taking concentrated bets, helps you transition between games without regret. The alternative is reactive change, chasing new trends or mimicking peers only after your context has shifted, often at the worst possible moment. Visibility and signaling distort perception of other people's games. Public markers, cars, houses, vacations are noisy signals that conflate consumption with success. They rarely reveal debt, leverage, or constraints. The prudent response is to focus inward. Private metrics, savings rate, optionality, margin of safety, and progress on personal objectives are more informative than public comparisons. When you measure what matters to your life, the noise of others' games fades, and choices become clearer. There is also a moral dimension. When you understand that others may be playing different games, you are less likely to judge or envy. You can offer help that matters, advice tailored to someone's goals, not to your assumptions. Generosity that recognizes different needs. Mentorship that clarifies trade-offs rather than prescribing a single path. Financial conversations improve when they seek to understand someone's objective function rather than impose a single model of success. Practical steps to apply this principle. 1. Articulate your game. Write down your primary financial objective, your time horizon, and the 3 risks that would most threaten your plan. 2. Align metrics to the game. Track the savings rate, liquidity, and progress toward goals that map to your objective rather than external status markers. 3. Choose allocations you can sustain. Match risk exposure to both horizon and temperament. If you cannot tolerate large drawdowns, accept modestly lower expected returns in exchange for the ability to stay the course. 4. Use phase rules. Define trigger points for shifting strategy, e.g., after accumulating a certain cushion or at specified life events, to avoid ad hoc changes. 5. Ignore visible outcomes. Treat peers' visible success as incomplete data. Ask questions before emulating. What was the time horizon? What risk was taken? What contingencies supported that path? The payoff for playing your own game is clarity and endurance. Financial life dramatically rewards consistency, compounding, preserved optionality, and the power of time. Those advantages compound most reliably when your choices are coherent with your objectives and sustainable given your disposition. Other people's headlines will always tempt you, but they are rarely calibrated to your map. Define your game, commit to measures that matter for your outcome, and do not let the noise of other games pull you off course. Ultimately, this chapter invites a modest but powerful reorientation. Success is not a universal standard measured by a single scoreboard. It is the alignment of means and ends in your particular life. When you invest and plan with that clarity, you reduce regret, increase resilience, and align financial actions with the singular metric that matters most, the life you want to lead. Chapter 17. The Seduction of Pessimism. Pessimism wears the air of reason. It speaks slowly, cites danger, and commands attention. Optimism, especially the quiet, patient kind that trusts progress rather than hype, often sounds naive or promotional. That asymmetry is not accidental. Bad news is immediate and visceral. Gains that accumulate over decades are quiet and easily overlooked. The seduction of pessimism is the human tendency to give undue weight to negative forecasts because they feel urgent and credible. Recognizing that tendency is essential for making sound financial choices. It helps us avoid paralysis, prepare practically for downside, and keep a long horizon when history rewards persistence. A first corrective is perspective. Look at long-term measures of human welfare and economic progress. Real GDP per capita across many countries rose substantially through the 20th and early 21st centuries. Extreme global poverty has declined dramatically since 1990, even after setbacks from pandemics and wars. Those are slow-moving structural successes that rarely make headlines the way crises do, but their cumulative effect has been transformative for billions of lives. Progress does not imply that every year is benign, or that new problems won't arise. It does suggest that over long periods, growth and improved living standards tend to prevail when institutions, technology, and trade are allowed to operate. That context tempers the allure of chronic doom as the only plausible narrative. Markets illustrate the tension between dramatic pessimism and quiet optimism. Equity markets periodically collapse in headline-grabbing fashion. 1929, 1973 to 74, 2008, March 2020, and each episode breeds convincing doomsayers. Yet long-term stock indices have historically produced substantial positive returns for patient investors. The compound returns across decades are the result not of constant certainty, but of enduring through repeated crises and recoveries. That pattern explains why pessimism feels smarter in the moment. It matches what your senses are seeing, while optimism, which bets on recovery and accumulation over decades, pays off only if you can withstand the interim noise. Real people live these dynamics in ways that reveal both danger and opportunity. Consider two investors during a severe downturn. One responds to bleak headlines by selling holdings to preserve capital, only to miss the rebound that begins shortly thereafter. The other, who prepared for volatility with a margin of safety and a plan for opportunistic purchases, uses the same episode to improve future prospects. Neither reaction is purely intellectual. Each is a behavioral response to fear. The lived lesson is that pessimism can be self-fulfilling for the unprepared. It nudges people to act in ways that lock in suboptimal outcomes. Preparing for volatility, with liquidity, diversification, and a clear plan, converts the seductive pull of pessimism into constructive discipline. That said, optimism is not a blind optimism for its own sake. Healthy financial thinking balances realistic caution with a recognition that long-term progress and compounding can overcome repeated setbacks. Optimism should be disciplined. It assumes risk management, emergency buffers, and an honest appraisal of the things you cannot control. A cheerful outlook unanchored to practical margins is as perilous as a gloomy outlook unanchored to opportunity. The most effective stance combines sober preparation for downside with a willingness to remain engaged for the upside that time and innovation historically provide. There are practical takeaways that flow directly from this balance. First, prepare for volatility. Build emergency reserves, limit leverage, insure against catastrophic personal risks, and diversify exposures so that a single shock cannot end your plan. Second, test your emotional tolerance. Choose financial strategies you can live with in the worst moments. Theoretical optimality is worthless if it leads you to capitulate. Third, cultivate a horizon. Anchor decisions to multi-year objectives rather than daily headlines. Fourth, treat pessimism as a signal to check structure, not to abandon it. Often, the right response to a convincing negative narrative is to confirm that your buffers and rules work, then act according to plan. Finally, there is a civic dimension. Pessimism can be politically and socially mobilizing. Warnings spur policy and prepare institutions for danger, but chronic doom can also sap investment, innovation, and cooperation. A balanced public discourse recognizes risks without surrendering to fatalism. It builds institutions that are resilient, markets that reward patient capital, and social norms that value long-term stewardship. For individual investors and households, the private analog is straightforward. Respect pessimism's ability to focus attention, but do not let it replace a disciplined plan that can endure surprises and benefit from the longer arc of progress. In short, pessimism seduces because it feels urgent and credible. Optimism endures because it is cumulative and often invisible. The wiser posture is neither gullible nor resigned. It is the careful readiness to survive the bad days and remain present for the good ones, a stance that acknowledges risk, prepares for it, and still believes that patient, well-protected participation in the economy tends, over time, to reward those who can wait. Chapter 18. When You'll Believe Anything. Stories are the currency of markets. A compelling narrative that a new technology will change everything, that housing prices only go up, that a particular strategy is the new normal, can mobilize vast sums of capital, reshape behavior, and convince otherwise sensible people to accept improbable assumptions. Financial bubbles are born where persuasive stories outpace sober evidence, and the result is a sequence of choices that looks rational inside the story, but is dangerously fragile outside it. Understanding how and why we believe these stories is the first step toward avoiding the ruin they can bring. Human beings are wired to prefer narrative coherence over statistical nuance. A remarkable-sounding explanation that ties disparate facts into a simple arc feels satisfying. Numbers that complicate the story feel like noise. This cognitive tendency to privilege a neat story over messy data is what fuels manias. In the late 1990s, the internet narrative that the web would remake commerce and every startup could capture enormous market share provided a compelling mental model. Valuations raced ahead of underlying economics. When numbers failed to meet the story's expectations, the reappraisal was abrupt and painful. The lesson is structural. Treat attractive stories as hypotheses to be tested, not as proof. Bubbles also thrive on social dynamics. Visible consumption media amplification, and the desire to avoid missing out create positive feedback loops. As more people buy into a narrative, prices rise, which validates the story in the short run and pulls more participants in. Leverage and easy credit accelerate the process. When borrowing is cheap, even marginal believers can amplify demand. The 2007-2009 housing saga combined loose lending, financial engineering, and a pervasive belief in endlessly rising home prices to generate a crisis whose damage rippled globally. That episode is a stern reminder that a compelling story plus structural enablers can convert optimism into systemic vulnerability. Economists and historians emphasize additional mechanics. Hyman Minsky described how stability breeds instability. Long periods of calm encourage ever larger bets, erode prudential standards, and make the system brittle. Kindleberger's accounts of manias and panics show a recurring pattern. Displacement, a new idea, credit expansion, speculative acceleration, and then collapse. These frameworks matter because they give us a checklist. When you see a new story, ask whether credit is expanding with it, whether valuations are diverging from fundamentals, and whether participation has broadened to actors with weak incentives to do deep due diligence. If several boxes are checked, skepticism is warranted. Practical defenses against the seduction of bubbles are behavioral as much as technical. First, cultivate probabilistic thinking. Ask not whether a story is possible, but how likely, and what range of outcomes is plausible. Second, demand durable answers to basic questions. How does the business make money when growth slows? Who bears the downside if the story disappoints? Third, avoid leverage that amplifies downside. Unlevered participation preserves optionality and the ability to wait for evidence. Fourth, diversify. Exposure to a broad set of assets reduces the chance that one narrative's reversal will be catastrophic for your personal finances. Fifth, set pre-commitment rules, rebalancing thresholds, allocation bands, and liquidation plans, so that decisions during euphoria or panic are governed by discipline rather than emotion. These are not infallible defenses, but they turn seductive stories into manageable risks. Real people's choices illustrate the stakes. Entrepreneurs who poured personal savings into business models justified by the latest hype sometimes found themselves unable to pivot when customer economics diverged from the promise. Ordinary investors who mistook rising prices for proof of permanence sold at devastating lows when sentiment reversed. Conversely, those who reserved capital, tested assumptions, and treated early-stage booms as experiments were often positioned to benefit from the subsequent reallocation of capital, acquiring quality assets at discounted prices when the air came out of the story. The human lesson is simple: humility about what you know and a reluctance to bet your life on the most attractive narrative preserve both capital and choice. Finally, this is also a story about incentives. Markets are populated not only by long-term owners, but by promoters, speculators, leveraged institutions, and media that reward attention. Ask whose incentives are aligned with yours. If a persuasive story is being sold by parties who profit from more volume, more trading, or higher valuations, treat the narrative with additional caution. Good investing habitually privileges independent verification over charming presentations. It privileges longevity of capital over the thrill of being right in the short run. In the end, bubbles are human phenomena. Psychological bias plus social reinforcement plus structural enablers. They are not always obvious while they inflate, but their anatomy is readable if you look for the warning signs. By testing stories, avoiding excessive leverage, diversifying, and designing disciplined rules for action, you protect yourself against the times when belief outruns reality. That protection is not cynicism, it is prudence. The capacity to remain skeptical of compelling narratives while prepared to act when they prove true is one of the most valuable financial skills you can develop. Chapter 19. All Together Now. If there is a single practical way to think about money, it is this. Treat it as a means to shape a life you can endure and enjoy, not as an end in itself. The preceding chapters have examined particular truths, the outsized role of luck, the quiet power of compounding, the need for margins, the perils of status signaling, but they converge on common, actionable principles. This chapter pulls those threads together into an integrated approach to money that privileges resilience, optionality, and the steady habits that produce durable freedom. Consistent saving is the engine of possibility. Small, repeatable acts, automated contributions, incremental increases tied to raises, and a refusal to let lifestyle expand as fast as income accumulate into options. Saving converts present impulses into future choices. The ability to change careers, to weather job loss, to take a sabbatical, to retire on one's own timetable. The arithmetic is unglamorous but uncompromising. You cannot invest what you do not first set aside. Prioritize the savings rate over the illusion of clever timing. Make the practice automatic so that behavior, not willpower, determines outcomes. Avoiding unnecessary risk is not the same as avoiding all risk. Growth often requires bets, but prudence separates constructive risk from reckless exposure. Protect against the kinds of risk that can end your plan. Excessive leverage, betting the household on a single venture, underinsuring against catastrophic health or disability. Structure bets so that they are survivable. The goal is not to eliminate volatility, which is the fee for higher returns, but to ensure volatility does not force irreversible losses. Build portfolios and lives that survive serious shocks, because survival is the indispensable precondition for any long-term advantage. Prepare for surprises by designing resilience into your finances. Expect the unexpected: job loss, illness, market collapses. Technological disruption are not curiosities, but recurring features of economic life. Resilience takes concrete forms: adequate liquid reserves, diversified income and asset exposure, sensible insurance, and governance rules that prevent panic-driven decisions. Resilience buys time, and time is the ally of compounding and recovery. When shock arrives, having a plan and a buffer lets you act rather than react. Value freedom above demonstrative consumption. The highest return money can offer is control over your time, the ability to choose what you do and when you do it. Status purchases are tempting because they offer visible affirmation, but they often impose obligations that reduce freedom. Invest instead in invisible wealth, savings that are not shown on social feeds, relationships that are cultivated with presence, and habits that allow you to trade income for autonomy when you choose. The quieter path buys dignity, optionality, and peace of mind. Designed for human behavior. Financial plans live in human lives, not spreadsheets. A technically optimal plan that you cannot follow is worthless. Favor systems that account for emotion, automation over choice, simplicity over complexity, buffers over heroics. Recognize your temperament and build a plan you can sustain through fear, excitement, and boredom. Reasonable strategies that you keep are always superior to theoretically perfect ones you abandon. Embrace humility about forecasts. Markets and economies are shaped by rare, consequential events and by forces that resist precise prediction. Humility translates into practical actions, conservative sizing of bets, diversified exposures, and contingency planning. It also means acknowledging the role of luck in outcomes and avoiding the temptation to overfit plans to stories of extraordinary winners. When fortune arrives, generosity and stewardship are appropriate responses. When fortune departs, prudence preserves dignity. Keep optionality at the center. Structure commitments so they are reversible where possible. Use staged escalations rather than cliff-edge decisions, and retain liquidity to seize opportunities or to pivot when values or circumstances change. Life is not static. Goals evolve. Designing for change through margins, flexible commitments, and periodic reassessment reduces regret and increases the probability that your future self will thank you. Finally, measure what matters. Replace public metrics of success, possessions, appearances, social signals with private metrics, savings rate, months of liquidity, freedom to choose, time spent on meaningful activities. Track progress against the life you want, not the life others display. These principles are not elegant rules for academic debate. They are pragmatic habits for living. They invite modesty, patience, and a preference for durability over drama. Money's most valuable work is quiet. It preserves options, shields against catastrophe, and buys the freedom to live by your priorities. If you adopt the posture of steady saving, prudent protection, and deliberate design for change, you will have done the most important work that money can do. You will have built, piece by piece, a life that endures and a freedom that compounds. Chapter 20. Confessions. Money, in the end, is a mirror. It reflects the choices you make about what matters and the habits that sustain them. In his Confessions, Morgan Housel strips finance of its glamour and returns it to the domain of human priorities. His creed is not a complicated algorithm or a contrarian market trick. It is an ethic of simplicity, patience, and the quiet pursuit of financial peace of mind. The confession is short and radical. Maximize the margin between what you earn and what you spend. Let time and compounding do the heavy lifting, and orient your wealth toward buying control over your life rather than buying permission to be admired. There is a humility at the center of this philosophy. Markets are noisy, luck intrudes, and forecasts fail more often than they succeed. Faced with that reality, Housel counsels modesty, reduce leverage, avoid bets that can end the game, and prize continuity over momentary outperformance. That posture rejects the seductive notion that optimal finance is a sequence of brilliant, risky calls. Instead, it treats investing as an endurance sport. The goal is not to be spectacular this quarter, but to remain able, mentally, financially, institutionally, to benefit from years of compounding and opportunity. The practical corollary is obvious, but often neglected. Lower variance in survival beats higher variance in headline returns when survival is required for long-term success. Simplicity is not innocent, it is strategic. Rather than obsessing over fine-grained portfolio tweaks or market timing, Housel emphasizes robust defaults. Save more, automate contributions, diversify across broad exposures, and keep costs low. These choices are effective because they reduce the behavioral burden placed on decision-makers. Habits beat hot takes because they remove the need for constant judgment calls that are vulnerable to fear and greed. In practice, this means designing systems that do the saving and investing for you. Payroll splits, automatic transfers, and conservative glide paths that adjust as life changes. Those systems will not produce magazine covers, but they will produce a life with options. Housel's confessions also place an unusual premium on savings as a moral and practical virtue. Saving is framed not as deprivation, but as the deliberate creation of optionality, the ability to leave a job without panic, to wait for the right opportunity, to handle emergencies without selling into downturns. Unlike investment returns, which are noisy and uncertain, the savings rate is one lever you can reliably control. Increasing the fraction of income deferred to the future compounds across years in ways that dependably expand your range of choices. That discipline, often more boring than brilliant, is the fundamental engine of financial agency. Patience, in Housel's view, is both temperament and tactic. The compounding of returns requires time and continuity. It punishes early capitulation and rewards the capacity to stay engaged. Patience is also moral. It prefers the slow accrual of freedom to the short-term thrill of conspicuous consumption or leverage-driven upside. Practically, patience means accepting that good outcomes are often invisible for long stretches and that the ability to endure inevitable setbacks is a superior skill to uncanny prescience about the next market move. Finally, Housel elevates financial peace of mind above the narrower goal of maximizing returns. Peace of mind is not an accidental byproduct of wealth. It is a measurable return on deliberate choices. Living below means building buffers and aligning spending with values rather than signals. Wealth used to reduce anxiety and expand autonomy is superior to wealth used to perform status. This orientation reframes success. The best financial outcome is the one that produces more time, dignity, and options, not merely a larger headline net worth. These confessions are not prescriptions for failure-free living. They are pragmatic answers to the messy truth that human lives change, shocks arrive, and incentives distort behavior. Their power lies in being implementable. Automate saving, design for survival, prefer simplicity, and keep the purpose of money clear. To buy a life you willingly choose. If you take Housel at his word, the most radical move you can make is modest. Live below your means so you have the freedom to say no and let time do what it does best. Over decades, that modesty compounds into the highest form of wealth, the capacity to live on your own terms with the peace to enjoy it.